Do we have a motion? Oh, I should mention, normally there's a 4-year term limit to serve as chair of a committee. We have, at the committee's request in prior years, done a waiver to that term limit, and we did that again this year. So the school board has approved a waiver, so any member of the Finance Committee can serve as chair. So I'd like to see if we have a nomination for chair of the Finance Committee.
Nominate Rick Miller.
Yes, second.
Okay, so Rick, are you amenable to serving as chair? Continuing?
Yes, I am.
Okay. So all in favor?
Aye.
Aye.
Okay, so Rick, you're chair again. And I'd like to go ahead and take a motion for vice chair. That was Mr. McDaniel, and he retired from the committee, so we do need a new vice chair.
Who's not here?
Mr. Jumar is not here. Mr. Koner is also is another committee member that's joining us virtually.
Good. Nominate Paul Dumars.
Okay. Any other nominations? I heard a second too. All in favor?
Aye.
Okay. I'll let Mr. Dumars know. He did say he was going to be here. He's probably running a little late, so we'll give him the good news when he arrives. Mr. Miller, do you want to run the meeting virtually, or do you want me to try to do it?
You got a good idea. Go ahead with it.
Okay.
I'll enter.
Okay, so I want to go ahead and do we got out of cycle, the welcome introduction. So if everybody could go around the table, introduce themselves, and then we'll have everybody that's in the audience come up to the mic, introduce. And the mic is so that it's recorded and we can get it later on video. So Mr. Warner, do you want to kick it off?
Jack Warner, Citizen Volunteer Committee member.
George Elmore. I don't know exactly who I serve here at Economic Council or whatever. But
No, you're appointed by one of the school board members. I'll get you the list.
Okay.
I'll send that out after the meeting.
Okay.
Bill Moore, citizen member of the Finance Committee.
Richard Pengelly, PFM Asset Management.
Leanne Evans, treasurer.
Heather Frederick, Chief Financial Officer.
Laura Howe, PFM Financial Advisors.
Christy Price, Treasury Department.
Barbara McQuinn, school board member.
Anna Patricia Morales, Deputy General Counsel to the school board.
Okay, and let's just get the people in the room, and then we'll go to everybody that's virtual.
Mike Baldwin, Jeffries.
Ryan Irvin, Raymond James.
Matthew Stansbury with RBC Capital Markets.
Stephen Lenahan, Wells Fargo Bank.
John Kern, Siebert Williams Shank.
Okay, and online, I know we have Rick Miller is here, chair of the Finance Committee, and Michael Koner is also a member of the Finance Committee that's joining us virtually. And we have Christina Zanali, and hopefully I get these right. Christina is with Estrada Hinojosa.
Yes, that is correct. And we also have Daniela Hinebra from our Miami office.
Hello. Good morning. And then I see Doug Draper from Bank of America, and I think you also have Tom Kai on the line.
Yes, good morning.
Okay, and then I'm trying to come up with all the names from the different firms. Frank Lito is from Citi. Irvis is in the Treasury Department in my office. John Generali is from Wells Fargo. Jonathan is running the mics for us, running everything. Laretha is from my office. I've already mentioned Michael Koner and Rick Miller. Rick Patterson. Rick Patterson, are you on the phone? He's traveling. He's abroad also.
Yes, ma'am.
Okay, welcome.
Yes, ma'am.
Ron Horan is in my office, and I already introduced Tom Kai. And there's somebody at area code 813 on the phone. Who's calling in on a phone line?
Hey, good morning, Leanne. It's Mike from PNC.
Okay, thank you.
Mike Hollis.
Okay. So that's the group. Is there any public comments? Okay. So the first thing we want to talk about, and I'm very excited about this one, I'm going to kick it off and let Laura talk about it a little bit. We did sell the 2023 COPs earlier this week. On Tuesday, we were in the market, and we've got a presentation that I will pull up. It went really well. The two key pieces that I keep bouncing off everyone, we were selling $142 million of bonds. We had $1.7 billion in orders. So it was a very successful sale. We also had a lot, I'm taking all Laura's thunder, but we also had a lot of new investors and very happy to see a diversification of our investor base. So, Laura, I've got the slideshow, and I can move slides for you. Do you want to talk through it?
So good morning. We're going to switch things up a little bit and first start and talk off about Bloomberg's B-Valve AAA callable curve, then go through a quick market update and then the summary of the transaction. So you may not be familiar with the Bloomberg B-Valve AAA callable curve. This is something that the PFM pricing group, and if we want to just go to the next slide so they can start to see this, that PFM's pricing group, after doing a lot of research and talking to different market participants, has decided that this is more favorable for a multitude of reasons to utilize other than the traditional, what you guys are all very familiar with, is the MMD curve. So this does allow more accessibility, so public access through Emma, so it's free to our clients to get at any point in time. They're able to go on there and access this curve. It shows what trades are eligible and the movement of the sources that it comes from. The B-Valve team monitors this on an hourly basis as well, making sure that the sources that are coming in are accurate and real-time trades are used. They look at the data that's being utilized in this as well and the supporting data that's gone. And one of the things for us, I know specifically, is that it's timely. It's every hour from 9 to 4, where MMD would bounce throughout the day. A couple times a day you would get a read. So that was why there was this transition and a push for it that PFM, and they've worked with the underwriters throughout to make sure that they were comfortable with this as well, using this as a curve to price off of, that we use our spreads. There's constant maturities as well, no monthly rolls on this, and it does have 32 points on it rather than year 1 through 30. We do have a 3 and 6 month read on this as well, which is helpful when we're pricing something that maybe is an 8-month first year read instead of pricing it off of the 1 year.
Yeah, so this really is like a benchmark when you're pricing debt. It gives you an idea of what's happening in the marketplace, and that AAA, we're not a AAA rated, our COPs are not AAA rated, but it gives us an idea of what yields we should expect, and then we're adding a spread on top of this. The fact that it changes hourly and we can see what's happening real time in the market rather than the MMD curve only updated overnight. So it lets us see what's going on intraday. So it was a transition. I know this time I wanted to see both benchmarks. I wanted to see what both curves looked like. But we used this, and it went. I didn't hear any complaints from any of the participants in the transaction. It seemed to go really well.
Leanne, how close are they effectively when they translate one to the other?
They're pretty close. I do have information that our pricing group had sent on this. I didn't include it in here, but I would say between 5 and 10 basis points over the past year is what it's been. So, but it can vary, and there was, some issues with the legacy curve, that there could be conflicts of interest is what's driving those points, where this, they're making sure that's what's being submitted. There's not a conflict that a person submitting in the curve is for their benefit.
Is this deemed to be more accurate or more accessible in some fashion?
Yes, absolutely. So, Leanne, any of you all could go onto the Emma website and pull this information and see the hourly rates that are coming out on the website to see where the market is moving at any point in time. So you don't have to pay for this access to it, so it is more transparent for clients.
If this is something you'd like to see, I can get a link and send it to you after the meeting. I know some of you are more interested in the market than others, but I can send this out to everyone after the meeting today.
And we can always, our pricing group, who's super in-depth in this, we can always ask them to come and explain a little bit more. The technical nuances of this is way above where I function on a day-to-day basis, but that's what they're there for, and so they would be happy, I'm sure, to come and explain this in further detail as well.
But that was a transition with this transaction, so I wanted to make sure we covered it, that we were using basically, I'm using a common term, it's a benchmark that we use. It's really, it's a curve for the bonds, but it was different, so I wanted to make sure you all were aware we were doing something different with this transaction.
Leanne, is there any commentary from the investment bankers at hand?
Anybody in the room, the bankers or online, anybody have comments?
I have a question. Did all the members of the management team bid, and how competitive were their bids?
There were stock orders. And
Well, this was a
Because,
negotiation.
I mean, frankly, you anoint them, they have to, they need to show up,
right.
as it were.
Well, these would, and Laura can chime in. At the end of the day, I want to see that the bonds are going to individual investors. I don't want it to be taken in as stock orders, but there were stock orders taken at the very beginning. I don't know if we can see.
We don't have the breakout yet of participation, but it was a negotiated sale where, and if you want to just go ahead and flip to that, we can get into the summary.
I know it's a competitive sale. I'm asking you what.
Well, it was
the performance
negotiated, not competitive. So Bank of America was the senior book runner on this. JP Morgan was a co-senior, and then we had the co-managers supporting this transaction as well. And so we don't have the final detail breakout of the liabilities of the policy of how it went yet.
So the management team bid as a management team?
Their desk went out that day between
Are there
9.
other bidders other than the management team?
Do we have the list? Do we have the list in here of all the bidders? There were 41 different firms. Investors that bid. We had 41 different investors.
And they bid on their own behalf, not through a
Right.
broker-dealer.
Well, they went through the desk because the desk, Bank of America's desk was leading the syndicate. So all the orders came in through that platform. But we will be looking at the participation for each member of the team. That's part, we just can't see all that data yet. Just happened on Tuesday. Let's see, I need to get to this. Here we go.
So this is a summary of the sale, and as we were saying, it is negotiated, that we sold this on Tuesday, November 28th. We went out with an order period for 2 hours into the market so that the team could go out and find investors to buy these bonds. We'll close this on December 11th. The total par amount ended up being $140,750,000. This was for the projects of the construction of $156.5 million. That amount didn't change, with a final maturity of August 2024, and they are callable on August 1st of 2023. The all-in true interest cost was 4.02%, and we did just include below, these were the parameters that the board had approved, was a par amount not to exceed 165. We were within that at the 140.75 million. And again, like I said, the project fund did not change at 156.5 million, but with the market and the uncertainty that we've seen this year, we added that in case we needed to use 5 1/4 or 5 1/2 coupons. There might have been less premium coming into this. Again, also why our not to exceed interest cost was much higher than where we finally ended up in the parameters. And we had used the final maturity potentially to 2048 to allow flexibility, but ideally for the district structure, we kept it at 2040. That's more favorable to them, and that's where the investor appetite has been as well. And the call is at 2033 instead of 2034, so a year sooner. And so this is the pricing performance of this, and as we've known, there has been quite a bit of volatility in the market throughout 2023. Going up to the sale, we started to see a rally where rates were moving in our favor, and that, provided a more optimal time to actually enter into the market than we have seen all year, quite frankly. And there was very strong investor demand for each of these maturities. As Leanne had said, more than $1.7 billion of priority orders, so those are going away orders, came in for $140 million of bonds. So the summary table below is showing you by maturity the principal that was being sold, and the amount of institutional, retail, and stock orders that came in. The stock orders are those that the co-managers will say, if these bonds aren't sold, we'll take them in-house. So that's not really what we focus on. We focus on the priority of orders, which is kind of in the middle of the chart. And that's where you'll see it was over 12 times subscribed. Every maturity was oversubscribed. There was 40 different investors that had placed orders through the syndicate to buy these bonds. Of those 41 investors, 29 were new, and they placed orders for 45% of the order book, which was awesome, the diversification of investors showing interest in the district's bonds. And there hasn't really been a lot of school districts that have priced this year in the state of Florida that would be comparable to Palm Beach schools. So we thought it would be interesting to kind of show where the spreads are off of the curve. So all the transactions up until the 2023, which is in the red with the dotted line, were based off of MMD, those spreads. And the 2023 is based off of B-Valve that we had switched over. And you'll see that in years 12, 13, 14, and 15, and 11, it looks like, these were the lowest spreads that the district has ever seen. So while we can't control the yields in the market, the spreads that were priced at, it was a very tight transaction, producing very favorable results for the district. And this is just showing you where we are at the 50% of the 1.5 mils, which is that yellow line, the 75%, which we're nowhere near, and the existing debt service and the layering of the Series 2023A on top, which is in blue on those bar graphs, that goes out to 2040. And so that expires currently with the rest of the debt portfolio that would mature in 2040 as well, leaving plenty of capacity for any additional needs that the district might have moving forward.
Yeah, one of the things that I'm focused on, we're keeping this final maturity short because we have capacity to pay it, but I also know we built a lot of schools in the late 80s, early 90s with a GEO bond referendum. Those schools are going to hit the 50-year mark in 2038, 39, 40 and out. And then we kicked in issuing a lot of debt starting in the year in 94, 95, and in 2000. We had years where we were financing 10 schools to open a year. So a lot of schools may come up and need to be replaced when we get beyond this 2040 window. So when we look at the structure of the transaction, and we could go out to 2048, I'm trying to keep it short to give the school board capacity to act when we get to that window of time. I will have retired by then, and most of the people around here will have retired by then. But we're trying to think ahead of where we're going to be in the future and keep looking at that long-term planning of where we're going to be. So I'm really happy with the structure. We do have another item on the agenda about a future COPS issue that'll be coming up in another year or so, and it would be layered on top of this. So we have plenty of room to issue debt as needed for construction projects. I think that's the last
Bill
slide.
Moore, how does 10 times the overbidding look to you? Is that very abnormal?
So, no, not this year. And even last year, there's been a lot of times where the underwriters have actually had to underwrite the bonds and take those in-house because we haven't had going away orders for them. So we were able to adjust between 5 and I think it was 11 basis points lower on these yields.
Nice.
Yes, so this was a very successful pricing for the district. I know we're right at the 4% of the all-in TIC, but considering where the market's been the past year and a half, having 12% oversubscription was a great turnout.
And honestly, there was a lot of high fives in my office when we hit 15 and 16% oversubscribed on specific maturities. So this was a fun pricing. I've done pricings where we were struggling to get bidders and to get the bond sold. So to see this type of market response was very encouraging, and it was a lot of fun to price. So kudos to the entire syndicate and to Bank of America that led the team. Any questions on this? This is not one we needed a vote on, but I always bring back the results of the sales when they're done. So it went really well. I will say
congratulations, Leanne, and investment bankers as well.
Yep. Yeah, I'll be happy to, if you have any other questions, we do have the final numbers of the breakout, and a couple of you, I think Mr. Moore would probably like to see the actual the backup behind the scenes of how it works.
I'm just curious to know how they performed.
Yeah, I'll be happy to send that out afterwards.
I think you have to have people who are in your underwriting group who are actually, doing something other than being along for the ride.
Right. I agree. One of the questions I asked was about retail. We had a low retail participation, and that's something I'd like to look at. But honestly, the results were so great, I can't really complain about lack of retail. And we've got some feedback from the group about retail participation. But it was a very successful sale. So we were very pleased with the results. So going back to the agenda, the next item, we did the election of chair and vice chair already. So we have the 2 annual reports. We have the annual debt report, the annual investment report, and then a reimbursement agreement that'll be going to the board on December 6th. So I'm going to start with the annual debt report. It looks very incredibly similar to what you saw last year, because the only debt issue we did in FY23 was done in August of 22, and we included it as a subsequent event of the report you saw last year. So very little has changed. The transaction we just did is not included because it was after June 30th. It was in December, so it's a little late to call that a subsequent event. So this report, I'm going to skim through this pretty fast because it's almost, like I said, almost identical to what you saw last year. It goes through, there's an executive summary that explains why we do it and how the Finance Committee came to be. It was originally just an investment committee and was expanded to be a Finance Committee to include the oversight of debt issuance. And I think that was a very smart move. I remember that came up from Tom Lynch when he was the chair of the board quite a while ago. And it's been a great thing that we did. So it was 2001 when that happened. So we've done a lot of debt since then. We can show present value savings of almost it's $169 million. And a lot of that savings, that comes from when we're doing refinancing or we're reducing costs of capital. That's where those savings come around. The swaps that we did years ago were part of that. And a lot of that, the credit to that certainly goes to the Finance Committee and to the board for letting us pursue those transactions. So we go through and list the different members of the teams. The underwriting team that is expiring in December, we will be doing another RFP for underwriters. We don't have any more transactions happening in the immediate future. Our procurement department is really busy. I've been busy with this transaction. We're kind of letting that expire, and we're going to do another underwriting team. I wouldn't be surprised if we see some of the same names, but there's a lot of people on the call and here that would like to be in the team. So we'll be doing a solicitation for underwriters in the coming months. So you'll be getting updates on that. So we have the history of all the debt, and I am not going to go through all this. You've heard it all before. But I've added this into the debt report because I used to get questions from the board and from the public saying, why do we have so much debt service? Why did we borrow money? So that's documented here, exactly why we had to issue debt. And, the changes, how many student stations have been built because of financing. We also look at the fact that the safety violations were reduced significantly when we built new schools and replaced old schools. So this is showing the reduction of taxing authority. If you remember back in 2008, the legislature reduced our ability to levy taxes from 2 mils to 1.5. And I always find this interesting. The red line is the amount of money we were receiving in 2008. We didn't get back to that level until 2022. Just thinking of pure cash, we didn't get as much revenue in for capital as in 2008 until 2022. It took us that long to get to where we're getting the same money, and in the same time, prices went up significantly. If we'd still had it 2 mils, we would have been back to that level at 2015. I mean, this is obviously the Great Recession with property values declining. So this is just part of the story of debt that we have to monitor that. So this is showing the outstanding principal. I had a question once from somebody saying every time we refinanced it, we were just extending the maturity, and that's never been the case. So when we do a refinancing, it's really reducing the amount of debt outstanding and reducing the borrowing rate. So we took a lot of payments down, and you see in 2020, that's when we started issuing debt again. but we continue to make principal payments to reduce the amount outstanding every year. So this is continuing to drop off as we pay off the older debt. So as of June 30th, it was $1.4 billion outstanding as compared to $2 billion in 2008. So we have paid off $600 million of debt in that period of time. Our long-term borrowing capacity, this is another document very similar to what Laura showed. And this is showing the proposed new money, which included the 2023s and some others. And at one time, we were planning to go out as far as 2028, and we have not done that. I hope we don't, but this is one scenario for long-term borrowing capacity. So there's still lots of room and lots of ability to borrow in the future for construction projects. And then we go through each type of debt, and I am going to go through this super fast. So the different types of debt we have is capital outlay bond issues. These are issued by the state of Florida on our behalf. There hasn't been any done since 2010, I believe, and it was refunding. So it's been a long time since the state is not issuing debt anymore, but this is still a type of debt that exists. Capital leases, we use these for a few years to purchase school buses and to do air conditioning equipment. We only have, I think, two more principal payments. The final one will happen in August 1st, 2024. So those are almost paid off at this point. COPS, we spent a lot of time talking about the certificates of participation, and we just added one new one in here. So this is just a summary and talks. It does talk about in 2022 we approved this transaction that we just did. And then we have some unique structures, the Qualified Zone Academy bonds and Qualified School Construction bonds. We call them QZABs and QSCIBs. These are transactions where the federal government offers to offset the interest cost by allowing banks to buy them, and the banks would get a tax credit. It does require a private match. The Qualified Zone Academy bonds, the ones we did were very small. The largest one, I think, was $2 million, but they work as a COPS. So there's a lot of work to do them for a very little amount of money. So the Finance Committee has agreed that we really aren't interested in doing these. They don't save us that much money in the scheme of things because they're so small. And then the Qualified School Construction bonds, these came out of the America Recovery and Reinvestment Act during the Great Recession. And we did one of these. It will mature in 2025. In theory, it's a good transaction. One of the things that's happened since then, when the federal government runs into budget problems, they have a process called sequestration where they decide they're just not going to do everything they promised. So we've not received all the funding from the federal government that was committed at the time. It's not something I would recommend doing, and I'm sorry to say I don't really trust the federal government for these type of transactions going forward. We're better off just borrowing on our own and doing it by ourselves. But we do still have this outstanding, and we continue to monitor it. The cost of sequestration at this point is 2.8. Let's see, the impact, the total is $2.8 million that of money that was owed from the federal government that we're not going to get. So that would pay a lot of teacher salaries, although it's capital, so it couldn't be used for teacher salaries anyways. It could be used to buy computers, school buses, other things. So, okay, then short-term debt. We used to do a tax anticipation note every year. We have not done one in the last 3 or 4 years. We haven't needed it. It's really a short-term borrowing to help us get over waiting for tax revenues to come in. And when we do those, we invite students in and we do a mock sale, and it's a big event. We really like doing that. It still didn't make sense to do one in 2023. I'm not sure we'll be doing one in 2024. Maybe by 2025, we may be back in the market. Other districts, some districts are still doing it. When we do the math, it just doesn't make sense. We don't need to borrow for this. And then the revolving line of credit was there for the sales tax. It matured on July 13th, 2023, so it is not there anymore. We never drew on it. It was there just to give us budgetary authority to go ahead and expedite the sales tax projects so they could go as fast as the construction department could spend the money. So the total fees on that through June 30th was $485,000. Our interest earnings far exceeded that on the sales tax. So this cost of this debt was really funded from the interest earnings on the sales tax. And we'll talk a little about interest earnings when we get to the investment report. Hedges, they've all been matured, but the ones we had from 2002 through 2006, we entered into them. They were all terminated by 2018. We had savings of over $40 million in the process through those swaps. The requirements for swaps have changed significantly over the years. It is much more onerous to do the reporting for them and to manage them. At this time, we have no interest at the district of doing swaps at this time. We don't want to take it out. We had this discussion with the debt report. We didn't want to take it out because there may be a reason we need to do them in the future. But we don't have any hedges outstanding at this time. And then our debt ratings have not changed, so they're exactly the same with stable. We just did go through ratings with Moody's and Fitch, and there were no change to our credit ratings. Definitions, and then we have lots of reports. It is easier to see this on a computer that you have in front of you, so you can make it bigger. I don't know, let's see, there's usually a button up here where I could try to make this bigger.
I think it's Control.
Yeah, but
And if you do Control Plus.
there we go. So this is a report, and this is a working document. All these documents I look at and refer to frequently. It lists every debt issue we have. And this particular report is required by policy. I keep adjusting it and tweaking it. It lists every transaction that's still outstanding, final maturities, how much is outstanding as of June 30th and August 1, which is when we make principal payments. So that's when you see a change that we've made. So for the 2015B, we made a $9 million principal payment in August. So it indicates if it's fixed or variable. We have no variable rate debt at this time. If it was new money, which means you were borrowing for construction for some kind of projects, or it was a refinancing, is what the R would mean. The interest rates, call provisions, comments on why we did it. If there is any exposure to market change, this is related to swaps and variable rate debt, so there is none. And if it's a public or private placement, and if it's hedged. So that information is all available. And then this report is one that lists all of the debt issues that we've done since the Finance Committee came into being. It lists them all. It has the issue date, if it was new money or refundings, the swaps, the transaction totals, and the present value savings. This is how, and then I've got a count so we can come up with how many debt issues we did. I really like this. It shows the amount of savings that we've had since the Finance Committee came into being. That's that $169 million that I like to brag on all of you about, that we've been able to achieve that.
Take my share, 10%.
Yeah, I take mine too. And this is another way of looking at the debt issues. These are the ones that still have ground leases. So this references the original debt issue and what project was financed, the square footage, the student station cost, if it was asset-based, which means it's in the ground lease, or non-asset. And then for each one, it lists if it was refunded, what and how much is outstanding for each one. So we use this regularly. If a school comes in and they want to do some type of lease or cell phone towers or any change to the facility, we need to know if it was financed because there are rules associated with tax-exempt debt. So this is a great tool for our real estate department and legal department to have so they know which schools are included in this master lease agreement. And then this is a document that PFM puts together for me, and it looks a lot better when it's hanging on the wall, and I have it hanging on my wall. If you go down to the bottom, it lists each of the original debt issues, and you can follow the lines to see when it was refinanced. So it's just a graphical picture of the debt, and we use this all the time in my office. So all of these documents in here, it's a report for the public, for the committee, for the board to see, but it's all useful data that we're using on a regular basis to manage debt. So I really like the debt report overall. I think it's very helpful, and it provides a lot of good information. I've not seen anybody else produce anything like this. I'm always looking for samples of other reports that exist to see if we can plagiarize off of it, take advantage, and use other good ideas. And I haven't seen anything else that's like this out there for schools. So we're very proud of this report. And I should mention Christy Price put together all the reports this year. Instead of me doing it, she pulled them together. So it's a lot of work. So thank you for your work that you've done on these reports. Any questions on the debt report?
Oh, beautiful job.
So I'm going to, and this will be going, these reports are going to the school board they're required to go to the board every year. They're on the December 13th board agenda. The annual investment report, and I'm going to let Richard talk a little bit on this one, but I'm going to get started. We have a summary that really lists, again, going back to our policy. And the investment policy is now an investment and cash management policy, started in 1972. And the last revision was approved by the Finance Committee just recently at the last meeting. It'll be going to the board next year. There were some minor changes that we all discussed. But it really focuses on how we invest, and it's the three rules. It's safety, liquidity, and returns. That's the three, and in that order. The most important thing is safety. We never want to lose money. Our dollars are all being used to pay salaries. Most of them are salaries or important bills. Electric, we got to pay the bills. So we can't afford to take risk with our investments. So we do have a very conservative investment policy. But having said all that investment policy, we're looking at the portfolio is overnight, short-term, and core. In 2023, our total interest earnings was over $71 million. So that's mostly due to the changing in interest rates. I'd love to take credit for that. Wow, that sounds great. But interest rates climbed incredibly, and we know that. They're over 5% now. So that makes a big change, obviously. And it does require that we change how we're managing money. This is how money was invested over the year. So this is that very colorful chart that we look at from time to time, and it breaks out what's in cash and what's in money markets, what's in short-term investments versus core portfolio and local government investment pools. It shows graphically how it was invested, and you see the big change that happens when tax revenues come in. Tax revenues are coming in. We've already received some money this year. We'll be getting more. I'm working with PFM. We'll be working with PFM to get a lot of that money invested as quickly as possible. And then again, we list the different companies that we work on, and we again express our appreciation of the Finance Committee for all of their support. And then we move on to the report. So this is the June 30 report. You've seen this already. We reviewed it in September, I believe, or maybe October. So we have that in there. And we also have PFM's report as of June 30th. But in the middle, we have a report that PFM gave us that is the year-end review of what happened over the course of the year. And Richard, did you want to highlight anything here?
Yeah, I just make a couple comments that, this is the time of the year when we do our investments, and unlike probably the past couple of years, it's going to be easier this year. It'll be harder because of the quantity, but easier just in terms of rates. Rates have, come up substantially higher than where we were before, $71 million for the overall portfolio. And from here, it looks like the Fed is on pause for some period of time, but we'll be able to lock in right now while we're doing our heaviest investing at these high rate levels. Next year, when we're at this point again, we'll sort of see where we are. The expectation right now is that we will be looking at a somewhat lower yield environment, but based on what we're coming off of, the near zero rate levels in the past decade or so, we feel that we're in a much better position investing this cash.
We had this discussion last time, but that would argue then for extending your maturities.
Yeah, so the long-term part of the portfolio really benefited from being short as we were dealing with the Fed fighting inflation and rising rates. But from where we are now, that'll be part of our cash flow analysis, is how much can we start taking out longer and how do we use the curve better? Mm-hmm. Absolutely.
I've actually got, and I haven't sent it to you yet, but an analysis showing monthly cash and where we think it's going to be. And at what point, it's a little different than normal, but looking at, can we increase the size of that core portfolio? Because the short-term portfolio is limited, it's under a year. So what do we need to keep liquid to cover the annual bills that we need to pay? What money are we not going to touch? So the board contingency certainly, that's what the core portfolio is. That's what we invest. And that does creep up as budgets grow, that amount grows. So it can grow up a little bit, but I'm actually looking to see, is there some more that we could put into that core, or maybe a middle of the road, something not a year and maybe not going out to 2 and 3 years, but at least get us beyond that year to do a middle of the road type of portfolio.
Very much make a difference.
Yes, yeah, it really does. So we're working on that, and we'll have, at the next meeting, we'll be able to show you all the work that we've done. So the rest of the report is, here's the year in review. So this was just showing that, the change in market values, the duration, the sector allocations, the credit quality. And this market, is this a current market update, or that was
No,
June?
Yeah, that's basically covering the year ending 6/30.
Okay.
We've
So-
already talked about all of that.
Yeah. So that really covers the investment report is a lot longer. It's reports that you have seen before. So I don't want to spend a lot of time with you going over things that you all have already seen. That was the June 30th report. So it's a big document. The important stuff is all at the very beginning. Are there any questions on that annual debt report, an annual investment report?
Quite a commendable job, I must say.
Thank you. So the last item on the agenda is a reimbursement agreement, which is, I'm not going to, let me just tell you what it is. We're looking at the capital plan. Actually, I think if I've got board docs open, I've actually got the language here of what I've told the board. When we did the capital plan, we knew we were doing the debt issue that we just priced. We didn't have any other debt issues in the capital plan. And the more we look at it, the more we realize we will need to do another debt issue next year. There were some of the projects that we planned to finance, the Roosevelt Phase 1 project and North Tech River Beach Prep. We're not ready to borrow for those yet. So one of the things that I hear frustration from bankers sometimes, why aren't we issuing the debt now? It's a great time to borrow. But if I don't know how much the projects cost, I can't borrow. I don't know how much to borrow. So these projects are not quite there yet. I don't know how much we need. So those were pulled out, and those will be done as taxable. So those weren't ready to go. And then we've also looked at the capital plan again, and we have a West Acreage Area Elementary School that was originally, we didn't know if it would be a school inside for property that was donated in Westlake or in Arden. The Arden development area has grown so much faster than expected. We need to get that school done sooner rather than later, and the capital plan moved it up. So their design has already been awarded. Pre-construction is coming at the December meeting. They want to be able to borrow money. They want to go ahead and do the contract in April, sometime in this. I'll say this spring, because it may take a little longer to negotiate it, but that's coming in the spring. And I'd originally planned to use property taxes to pay for that. But I keep seeing construction prices going up with sales tax and other things, so I'm recommending we shift that to a COPS issue. And then the Roosevelt Phase 2 and Delray Service Phase 2 that were added to the capital plan, we originally were doing them as sales tax, and I'm recommending they go into a COPS issue as well. So we've got 2 COPS issues that will be coming up in FY25, probably the fall of 24 or early 2025. That COPS issue is not in our capital plan, and we need to go ahead and start spending some money. So the way we do that is to go to the board with what's called a reimbursement agreement. It's actually a document set up for the IRS that says the board acknowledges they're going to issue debt. We're going to go ahead and spend money and be able to reimburse ourselves with a debt issue that'll happen a year or two from now. So this is going to the board on December 6th to get authorization. We want to make sure the board knows what we're doing because it's changed to the capital plan. And we want to make sure we've dotted the I's and crossed the T's as far as the IRS is concerned before we start spending money. The other project that we're considering with this is what the school on the land that was donated within the Westlake community. It's growing fast as well. It's not currently in the capital plan. It will be added in the next one. That's part of this plan to borrow money in FY25. So the bankers all know, as soon as I say there's no more cops, all of a sudden there's a cops issue that comes up because something changes. They all laugh when I say there's no more debt because they know it's coming. So this is getting ready for the next one that would happen. We'll be talking about this in a year from now, but we need to get the board's approval to go ahead and start working on it.
Do we need to vote on it?
Yes,
now?
we do. We actually need a vote on, when I should have done this, thank you, Rick, for being the chair. We need to have a vote to accept the annual debt report, the annual investment report, and the reimbursement agreement. So we could do one at a time. So let's
Up to you.
Yeah, let's go back to, I think there were no questions. Can I get a approval of the annual debt report?
So
We have a
moved.
motion to approve?
Yes.
Sure.
Okay, all in
And
favor?
there's a second.
Aye.
Aye.
And I heard Mr. Koner's voice too. I think we're all good there. Same thing with the annual debt report. Can I get a motion to accept the annual investment report? Sorry.
So moved. Second.
All in favor?
Aye.
Aye.
Okay.
Aye.
Thank you. And the last is that reimbursement agreement for the 2025 transaction.
So moved. Second.
Okay. Any discussion there? All in favor?
Aye.
Okay.
Okay.
Thank you very much. On the agenda, and let me go back to this, it's not on board docs, but on your agenda, I have listed the future meeting dates. The next one is February 9th, and then the one after that is going to be either May 10th or May 17th. The audit committee has booked the room for both days, and I know they don't need that, so I'm working with them to figure out which date they're going to use, and we'll take the other one. I think it's going to be May 10th, but I'll confirm that. So I have the dates for 2024 listed here. We do have 3 in a row, August, September, October. We usually end up canceling one of these, probably September, but I know that's also summertime. And usually I send the notes out and we'll find out we don't have a quorum on one of those dates and we flip to another. So one of these will fall off. We won't need, unless something happens in the markets, we don't usually need to meet every month. So as we get closer, I'll be sending notes out. I'm going to try something different with the calendars. I'm going to load them all out there and call it Finance Committee placeholders. And 2 weeks out, I'll delete the placeholder and replace it with an actual one with the link for virtual. Because what I found in the last year is I put it out there and people accept it, and then things change with their calendars, and then I'm having to send emails to bug everybody. And I hate doing that. I really hate having to bug people and send notes out. So I'm going to put a placeholder on your calendar, then I'll replace it with an actual one 2 weeks out, and you can confirm it, and that way it's fresh in your mind that it's coming, and still send the reminders. But I'm trying something new this year. So if you don't like that, please let me know, and I'll try to think of something else.
Well, the reminders are good. I have to say that.
Yep. Okay, and that's all I have for you. Again, I'd like to thank you all for coming, and I hope you all have a wonderful holiday. We're coming up that time of year.
Can I just make a comment? I heard you say that you were going to have a review of the management team sometime. I have a peculiar view of this, which is that, having a large management team is an inefficient way to operate. Secondly, the minimum spread for the managers is not always the best thing. We want to, I'd rather incentivize them with a larger spread and let them put some of their capital at risk in trying to distribute the securities.
Okay.
So won't be participating in that selection process, but I want you to understand that I really do think that having a large, I realize that, listen, I was in the business. I understand the pressures associated with adding people, but it's not a profitable way to conduct yourself. And so a smaller group of deeply committed managers is a far better thing, and let them work for a little bit more money and make it more than make it up by reducing the coupons on the securities. So that's just a general admonition to you. The this committee, which will be considering the matter.
Yeah, I agree with you on the size of the team. There was an issue with the selection process, and we ended up making the team larger than we originally anticipated this last time. We managed that by setting it up towards a rotation. We never have all the underwriters on the transaction at one time. We have a senior, a co-senior, and 2 or 3 co-managers. So we make it a smaller team, and that works really well if we're issuing a lot of debt. And we're not going to be issuing a lot of debt, at least not that I can see. And they're all going to laugh and say, when I say there's no debt, there's more.
You have an excellent financial advisory firm. I understand that, but it's also nice to get free advice from other people, and if they're prepared to do that on an ongoing basis during the
and we do hear
period
from
of
the
that.
underwriters. We used to hear a lot more when we were able to do advance refundings.
Right.
Whoever proposed first and gave us the best idea first would get to be the book runner on that transaction. That worked really well. Those aren't allowed anymore, which is unfortunate. The federal law changed.
Those are the good old days.
Yeah, that was the good old days. We're
yeah.
not allowed to do that anymore. But they do. I do get information from the underwriters all the time. They send me market updates. They send ideas when they've got them. They see something new in the marketplace. So we do get that advice from them, and we do see things from them. And I'm working with Laura from PFM on the underwriters RFP to see how we're going to write that. I'm not allowed to share the RFP with you all in advance because it's a public meeting. We actually had legal tell us we could not do that anymore. But I certainly will incorporate your feedback. And when we get to that point, if anybody wants to be on the selection committee or would like to be a non-voting member, we've had that in the past, and I know it's a lot of work. I'm fine with you there or not there, either way. And some of you have conflicts with being on a committee. But if somebody wants to serve on that committee, just let me know separately because we can build that into the structure. We can also set it up that you're there just to observe, that you want to be there as a non-voting member. So we can accommodate that if that's something any of you would like to do. As a non-voting member, you're not required to read through everything and score it. You just get to read through it and give me your opinions. So it's a lot easier than scoring. It is a lot of work to read through them and score them. So I understand everybody shakes their head and they don't want to do it. But if you want to participate as a observer, we can do that too. So I'll probably bring that back. At least I'll bring it up again at the next meeting because it won't go out before the February 9th meeting. It would be after that. Okay. I don't have anything else. Anything else from the group?
I've got one.
Yeah, thank you, Leanne, for a good year, and thank you to the Finance Committee and participating and your staff, who are excellent. Also to PFM, who does a great job, and the bankers.
Yep. We do have a great team. People here, people online, people traveling. We do have a remarkable team of people that are helping us do what we do need to do for the school district.
And how has the transition gone from David Moore?
That's just fine. Laura's here. And Laura was the advisor on the debt issue, and it went really well.
Good.
Yeah. Yep.
Well, happy holidays to all of you.
And Mr. Warner, you have a question?
No, and I'm not sure if Rick has already done this, so forgive me if I'm redundant. I wanted to make a motion that the Finance Committee recognizes Leanne and her team for their performance throughout 2023. Again.
Okay.
You're here.
So if I repeated what Rick just said, I apologize.
No, I think that's a great idea. Let's make a
Do I have a second for my motion?
Yes.
Second.
All in favor?
Aye.
Aye. Thank you.
One last question. How was the breakfast?
I think breakfast was good. I see nodding of heads.
Biscuits were real good, but you missed it.
I know.
Okay, well, thank you very much. I hope you all have a wonderful
Merry
holiday,
Christmas to everyone.
Happy New Year, and we'll see you all in 2024. Thank you.